Welcome to Key Points for January. This month, our view on the recent market turbulence, why we think the economic cycle has got further to run, and why we believe that risk assets are currently going through a bottoming process. So, to our first point, 2018 turned out to be a torrid year for most financial assets. Risk assets had the worst performance since the financial crisis, and even the S&P 500 stock market, which had done so well throughout the year, finally succumbed, with December proving to be the worst December actually since 1931. Clearly a combination of slower growth, political and geopolitical tensions all played their part, leading investors to pull money out and look for safe haven defensive plays through the end of the year. Now, this felt a little bit like it did at the end of 2015 and 2016. However, we don't believe this is the end of the cycle, and we think there is value to be offered, certainly within equity markets. So turning to our second point, we believe that the economic cycle still has further to run. Investors have become overly pessimistic, pointing to a slight inversion of parts of the US yield curve to suggest that a recession may be imminent. We think it's a little bit further out, and actually economic conditions remain good. In the United States, the labour market is doing very well. Latest data show that wage growth is picking up 3.2%. And in Europe, we've got a bit of a fiscal initiative coming through in the key markets of Germany, France and Italy. And idiosyncratic factors which held back growth in Europe towards the end of 2018 are likely to dissipate. So growth is going to be decent, we think, both in the US and in Europe. Now, clearly one worry is China, and I think that's legitimate. We've pushed back our view about when the economic numbers are going to stabilise. Growth has been slower than the authorities had hoped for, and the fiscal initiatives and the tax cuts that we've seen are likely to take a little bit longer to come through to support that economy. So still okay for China, but we think it's going to take a little bit longer for the economic data to improve. So to our third point, we believe that equity markets in particular are going through a bottoming process that will take a little bit longer. The good news is that valuations are now quite attractive. Earnings estimates for 2019 have been cut to around mid-single digits for most markets. PE multiples have compressed significantly, the US trading about 14 times 2019, with some emerging markets even lower, around about 10 times. So this offers a good base, a good platform, I think, for markets to move higher once investors believe that the cycle indeed hasn't ended. Now, this is likely to take some better economic news coming out. It is likely to take some better indications from China that additional stimulus would be taking place. And of course, it would be helped if we see some kind of progress being made on the US-China trade issues, which we think will happen a little bit later on in the year. So a good launch pad, still volatility expected, but upside potential we still think for equities, which remain our favourite asset class. Remember that all of our publications, including the January Investment Insights, can be found on zurich.com/MSME.